Hello, and thank you for joining us today for this Edward Jones webinar, Making Cash Work for You, no matter the market environment. My name is Sandy Miller. Before we get going, let me highlight a few of the features on your screen that we're going to be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides and a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We will do our best to answer your questions in the allotted time we're given. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the resources icon, which is located next to the Q&A icon. All right, now that you know your way around, let's get started. With recent market volatility, many investors have turned their attention to cash and cash-like investments. When uncertainty looms, you may find yourself asking, should I keep the money in cash or invest it somewhere else? Today, we're joined by Edward Jones Senior Analyst Kyle Harpin and Edward Jones Financial Advisor Travis Lois. And thank you both for joining me today. Kyle, let's start with you. What role does cash play in an overall financial strategy?
Thanks, Sandy. We know there's been a lot of interest in cash and cash-like products from investors recently. As an example, at the end of 2022, U.S. investors held a significantly higher amount of cash, money markets, CDs, and treasuries than they did at the end of 2021. Moreover, search data from Google indicates that interest in high-yield savings accounts, CDs, and treasury bills has been at all-time highs so far in 2023. Because of this, many investors are wondering, how does cash fit within my overall financial strategy? Well, cash actually serves multiple roles within your overall strategy. It's used for spending, emergency savings, short-term goals, and can even be a small part of your investment portfolio for longer-term goals. Now, cash, like anything, has its benefits and drawbacks, which means you probably shouldn't hold too much of it or too little of it. The biggest thing to remember is that it's important to hold cash in appropriate amounts relative to your goals. So a big question we get is, how should I think about balancing my cash strategy with my investment strategy? To answer this, it's helpful to ask yourself these three questions. Why are you investing? What do you risk by not investing? And what role does cash play within your overall financial strategy?
That makes sense. So Travis, thinking about why clients invest, how do you help clients establish their financial goals? And are those clients able to adjust as life changes?
Sandy, those are actually two very important points. Understanding the importance of establishing their goals, but also knowing that adjustments may need to happen over time as life changes. So everything that we do with our clients starts with really learning about them and understanding who and what is most important to them and why. We got to take the time to really discover what gets them out of bed in the morning, what keeps them up at night, understanding what's unique about them, their feelings, their attitudes, their values, their fears, what's their purpose, what's their why. This builds the foundation for helping them to identify and prioritize their goals. So as I develop an understanding of them, I can then really go to work on developing a personalized strategy that positions their dollars in direct support of what's most important to them. And from there, my job is to help to implement those strategies with specific action steps and coach them over time on what they can be doing to move closer to where they want to be. It's very important to me that I'm proactive with my clients about what they can be doing better, and then helping to guide them through those pivots, those changes that we talked about as life changes. Priorities change over time. So it's important to have a strategy that is flexible to be sure that we can always direct those dollars in support of what matters most to them.
So for those who find themselves with an excess of cash at their disposal, what can they do with that money in regard to their investment goals?
Great question, Sandy. A key element to answering this question is something that Travis just mentioned. When you have excess cash available, think about why you're investing. Your why for investing can help you in two main ways. It informs the investments you own, and it can help focus your attention more on the goal and less on the swings of the market. Let's start with where your cash should be invested. Each investment you own should have a reason for why it's part of your portfolio. And that reason for why it's there should be tied to your goal. So when you have cash available, the question of what you invest your money in becomes a lot more straightforward. For goals that are more long-term in nature, your portfolio will likely be tilted more towards long-term investments, like stocks and long-term bonds. Alternatively, for near-term goals, your portfolio will likely lean more towards shorter-term investments, like cash and CDs. Now, let's talk about how your goal can focus your attention. The market swings we've lived with over the last year are enough to give any investor pause. From inflation to banking turmoil, it has some investors questioning whether they should even stick with their current portfolio. However, focusing more on your why for investing brings your attention up a level. It can help drown out the noise of the markets when times get tough. More importantly, by thinking more broadly about your goal, you can also think more broadly about how to achieve it. It can become less about the day-to-day market swings and more about the strategies you use to achieve that goal. For example, you could focus on investing on a systematic basis, committing to future savings increases, tax loss harvesting, or rebalancing your portfolio at certain intervals. These are just examples, but they show how you can shift your focus from the day-to-day market swings to the strategies that can help you achieve your why for investing.
For those who may have something like a CD nearing its maturity, Travis, what options do they have with those newly available funds?
Good question. So things like maturing CDs are a great catalyst for new discovery conversations. For those who find themselves in the situation where they've got extra cash, it's an opportunity for us to sit down, discuss what purpose that money can serve in ultimately helping them to reach the goals that we've identified. I'm going to sit down with you. We're going to have a conversation about your goals. Have they remained the same? Are there slight changes, maybe drastic differences? This will help us to figure out the best use of these new funds. We'll talk about whether you have the 4 uses of cash covered. Do you have a short-term need for the cash? Are you holding the right amount of cash for your emergency fund? Or are you potentially holding too much relative to what you really need to direct over to your long-term goals? And maybe there's something better we can do with that money. I want to sit down with you and get a clear picture of your situation and your objectives. And from there, we'll develop a set of goals that makes the most sense for you and your situation.
Kyle, it may not sound possible, but there is such a thing as having too much cash. Why is that?
Yeah, that's a good point, Sandy. While cash absolutely has a place in a client's financial strategy, it needs to be right-sized with the other parts of it. If you hold too much in cash, CDs, or short-term fixed income, you may be taking too little risk when it comes to investing for your longer-term goals. That's because investments that come with more risk often have the potential for higher returns. This trade-off might not seem like much when interest rates are relatively high, but it can impact whether you achieve your goal over the long term. Let's take a client whose goal is for their portfolio to supply them with income in retirement. Assuming a 4% withdrawal rate and a long-term inflation rate of 3%, an all-cash portfolio has a less than 1% chance of lasting more than 25 years, while a 50% stock and 50% bond portfolio has about an 80% chance of lasting more than 25 years. Why the big difference? Because growth is needed to help offset inflation over time. Now, the flip side of taking too little risk is taking too much risk. Not only does it increase the potential for losses, but too much risk can make it difficult to stick with your investment strategy when markets get volatile. This can potentially result in the worst of both worlds, selling after a decline and then missing the market recovery. A key for you is finding a balance in your investments that allows you to earn a return that helps you achieve your goal and stick with your investments in good times and in bad. And that's one of the many things our financial advisors, like Travis, are here to help you do.
Travis, Kyle mentioned earlier that interest rates are currently at relatively high levels. How should clients be thinking about that as they look at their cash holdings?
Well, rates have definitely increased rapidly, and right now we're at levels we haven't seen in over a decade. These higher rates can be a great opportunity to optimize your cash holdings by looking for a higher yield savings account or another cash-like product with a better rate of return for one of those 4 cash uses. But when it comes to your longer-term goals, there are 2 things to remember when it comes to current cash rates. First, they're current. If short-term rates come down, cash rates will likely follow. And second, inflation is still higher than many cash rates. So while it might feel safe to hold cash, cash currently has a negative real return, which means a large allocation of cash could actually take an investor further from their long-term goals, not closer to them. So while higher rates can be a great opportunity for your cash holdings, it shouldn't be looked at as a replacement for your long-term investments within your portfolio.
Let's go back to one of your previous points, Kyle, and that was making sure you have the appropriate amount of cash relative to your goals. So what is the right amount?
Certainly. The answer to the question, how much cash should I hold, is going to differ from person to person. However, we have a framework that provides general recommendations for the amount of cash to hold based on your particular use for it. Under this method, cash has 4 main uses: unexpected expenses or emergencies, short-term goals, everyday spending, and as a source of investment for your portfolio. Now, a quick story about how the year started for me. In January of this year, our hot water heater unexpectedly quit on us. Then in February, it was our heating and AC units that stopped working. As rough as those bills were, and believe me, they were rough, they would have been even more crushing if we didn't have an emergency fund to help cover them. Having emergency funds saved and easily accessible will help in the event that you have a medical emergency, a job loss, or another unexpected event in life. We generally recommend having 3 to 6 months worth of living expenses saved in a separate account for emergencies. Cash can also be used for short-term goals as well. This could be something like a down payment on a home, a vacation, or even a new car. The amount of cash saved for these goals is going to be determined by your vision for the goal. Work with a financial advisor to determine this amount. You should also have enough cash on hand for your everyday expenses. In general, for somebody that's still working, we recommend maintaining a checking or savings account with 1 to 2 months of cash in it for everyday spending. Now, if you're retired, we generally recommend a year's worth of living expenses in cash, reduced by the amount you receive from outside sources, like Social Security, a pension, or an annuity. Cash can also be a small part of your investment portfolio for your longer-term goals. Within the portfolio, cash has 2 main allocations, a strategic allocation and a temporary allocation. Let's talk about them both. A strategic allocation is an intentional cash holding that is based on the outlook for interest rates, the markets, and the economy. It should generally comprise between 0 and 5% of your overall investment portfolio. A temporary allocation is one that can result from something like a CD maturing. If it's being used for spending, a short-term goal, or emergency savings, you could optimize those cash holdings and take advantage of the historically high rates we're seeing. But if the cash isn't needed, if it's above the enough amounts we've been talking about, these temporary allocations should generally be targeted for reinvestment within the portfolio.
Travis, what does the process entail when it comes to figuring out a client's cash needs?
I'll tell you, it's a little bit of a Goldilocks scenario. Not too hot, not too cool, but just right in the middle. The same thing applies for cash. Kyle mentioned, it's It's about having the right amount, not too much, not too little. It's important that I educate my clients on matching the appropriate investment for each of their goals. Longer-term goals are better supported by investments that provide more attractive long-term results. Shorter-term goals are best supported by investments that shelter from risk. This is where cash comes into play. Kyle identified the 4 uses for cash: unexpected expenses and emergencies, specific short-term savings and spending, everyday spending, and then finally a source of investment for taking advantage of opportunities. Our process allows us to really evaluate a client's attitudes and comfort levels, as well as income sources, regular expenses, goals, and any planned spending that may be coming up. Then we make a specific recommendation for each of these areas based on a client's specific situation. But again, it is so important to understand that having the best chance of achieving your goals means matching the right investment to each goal that it's meant to support.
Any final thoughts?
A key element to achieving your financial goals is remembering why you decided to invest in the first place. With a clear line of sight to your goals, your cash strategy and your investment strategy can be aligned to your overall financial strategy to help you achieve your goals.
If you have a long-term goal, such as retirement, your portfolio may be more focused on those growth-oriented investments. And for a short-term goal, you should focus more on cash and bonds. The key is to start with your goal and then work to build your portfolio and strategy around it. That's why I'm here. That's why all of our Edward Jones financial advisors are here.
Thank you both so much for your time today and for sharing your knowledge and insight. As I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session. Rest assured, the webinar is still live. We will do our best to answer your questions during the allotted time. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. Please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.